Hey folks, welcome to a product review at Finominal. Today we're going to look at merger arbitrage ETFs trading in the US stock market. Now, what do merger arbitrage ETFs or funds do? Now, they aim to provide uncorrelated and positive returns to traditional asset classes and therefore provide diversification benefits. Now, 20 years ago, merger arbitrage or merger arb, how it's being abbreviated, only used to be available via hedge funds. Now that changed by this strategy being available also via mutual funds, and then, well, for a decade or so, also via ETFs. So today we're going to look at 4 merger arbitrage ETFs trading in the stock market. And we're going to use the largest merger arb mutual fund, which is trades on the ticker MRGR, as the kind of benchmark. Now, let's kick off with the performance review. Now, what we do see over here, the performance of the 4 ETFs plus the kind of like benchmark index, which is like a mutual fund, doing merger arb, right? And we have almost 5 years of returns. Now, what we do see is that out of the 4 ETFs, actually only one managed to beat the MRGR, and that was a product from allocators with the ticker ARB, right? So that generated a high return. Having said that, returns are not that meaningful in terms of looking at them without the risks associated in generating those. So let's move on to simply like the risk versus return or Sharpe ratio analysis. Now, what we do see is that the benchmark fund, which is MRGR, right, effectively had the lowest volatility and, well, almost the highest return. In contrast, all 4 ETFs had much higher volatility for these type of instruments, right, and not necessarily high returns. Stated differently, right, none of these ETFs had a Sharpe ratio as high as a mutual fund. Now, in general, we are fans of selecting cheaper instruments, right? And the fees for most of those merger arbitrage ETFs are far lower than for the mutual fund, right? 76 basis points, 55 basis points. Well, this one's a bit more expensive, but this one's cheaper because MRGR costs 170 basis points. Having said that, given that it also generated the highest Sharpe ratio, does actually put this fund a little bit more, the mutual fund a little bit more into an attractive position versus the ETFs. And usually it's not great to pay higher fees for funds, but there are a few exceptions. Perhaps this is one. The other important point with regards to merger arb ETFs and funds is if they offer actually what they are claiming to do, which is provide uncorrelated returns. Now, we can run a quick correlation analysis. And over here, we see the correlation to stocks and bonds over the last 5 years of the 4 ETFs as well as the mutual fund. Now, what we do see is that the correlations were low, 0.2 to 0.5. Now, having said that, this is kind of interesting to think about merger arb funds that, well, first of all, the correlation is not zero, right? Because there are alternative strategies that have correlations close to zero that are more diversifying, right? So that is something to be cognizant of. And then the interesting part about merger arb is, right, so they provide mildly uncorrelated returns, but would they have actually generated diversification benefits? In order to evaluate that, we're going to take the ETF with the longest track record, which is the product from New York Life, the merger arbitrage ETF with the ticker MNA. And we're going to put that into the fund analyzer. And here we have, I think, close to more than 10 years of data. And we're simply going to evaluate on the diversification tab if this fund would have generated diversification benefits. And so what we see over here is that the average correlation over the last 15 years was 0.45, which is, well, not highly correlated, but not low either, right? But if you would have added a 25% allocation to a portfolio of the S&P 500, the Sharpe ratio would have not increased over, well, the last 15.7 years. Stated differently, right, MNA, despite its seemingly low correlation, has generated 0 diversification benefits. And unfortunately, this is the general issue with merger arbitrage funds, that the average correlation to equities is low, because the way a merger arbitrage fund is constructed is by building pairs of companies that are about to be acquired. That's your long position, and you're shorting effectively stuff that is acquiring the company. So you have a kind of portfolio of beta neutral pairs. The problem is that when stock markets crash, for example, like during 2020, then effectively mergers fall apart and your correlation to equities spike. Unfortunately, this is of course exactly when you need diversification benefits, right? When you need a diversifying strategy to provide uncorrelated returns. And this is kind of like the structural issue with merger arbitrage funds in general, that the correlation is low on average, but it does spike when you most need it, and therefore it makes them poorly diversifying strategies. Hope that helps. Have a nice day.